Selectors is a company that manufactures farming equipment. Selectors Limited was incorporated on 1 January 2013. On this date, the company was also registered for value-added tax. A VAT rate of 14% is applicable for the current financial period. You have been transferred from the taxation department to selectors to the accounting department. At first, this was a huge challenge for you, but after spending hours on conducting research on all the changes to the accounting standards since you completed your degree, you feel much better about life and actually are looking forward to the new challenge. You were assigned to the following responsibilities: to process all transactions relating to property, plant and equipment, to ensure that all fixed assets are accounted for by means of an asset register, that for all fixed assets proper source documentation are kept, that depreciation on all assets are adequately provided for, and together with your colleagues prepare the note for property, plant and equipment as required to accompany the financial statements of Selectors. Selectors adopted the cost model to account for all non-current assets, and depreciation is written off as follows. Right, on vehicles, straight line method equal to 25% per annum on the year of service, and machinery, units of production method. In terms of IAS 8 accounting policies, estimates and errors, the entity adopted the application of the reallocation method to record and disclose any disclosure of any changes in estimates. So it is part and parcel of their policy. They have decided if they're going to affect a change in estimate, they are going to use the reallocation method. Selectors had 2 machines on hand as at 30 June 2016. Now let's just establish who we are, where we are. Present the property, plant and equipment note pertaining to the statement of financial position of Selectors as at 30 June 2017. So this is the IAS 16 note, showed all your calculations. Should any item be omitted from the value of your calculated amount, clearly state the reason for such an omission. The accounting policy note is not required and the total column is also not required. Good, so if we go back here, we know that we are busy with the 2017 year. And here they give us the information as at the beginning of the current financial year. Machine X001 that was purchased for 1,484,000 VAT inclusive. Let's immediately take out the VAT. We are a VAT vendor. We would have claimed the VAT. So the VAT exclusive amount would have been 1.3 million on 15 January 2015. And machine X002 that was purchased for 950,000 paid in cash on 1 July 2014 from a non-VAT vendor. So that 950,000 will be the cost price because a non-VAT vendor cannot issue a VAT invoice, so you cannot claim VAT. Machine X002 is brand new, also not second hand. Selectors by means of professional judgment and research on similar assets estimates the following. Now here's machine X001, machine X002, estimated total production, number of units, and what do we use for machinery? The units of production method. So this is total capacity per machine. And then the estimated residual value exclusive of VAT per machine. The following units were produced by the 2 machines in the respective financial years. Now, machine X01, X02, the number of units, and here we have 1.7 million for X001 in 2015, and in 2016, 1.8 million. So if we add the two together up to the beginning of the current financial year, it equals 3.5 million units. If you look at machine X002, it is 225,000 in year 1, and it is 350,000 in the 2016 financial year. So if we add that all together up to the beginning of the current financial year, we have manufactured 575,000 units. And then obviously the last one, that is the current year's production. Due to unforeseen circumstances, machine X002, that one, was not productive during the period 1 April 2016 to 29 April 2016. Normal production resumed at 30 April 2016. Now we use the production unit method for machines. And because we use the production unit method, it's all about the actual amount of units produced, what is going to determine our depreciation charge. So therefore, it doesn't matter what period of time this machine was idle, that will automatically be reflected in the number of units that we've produced. So we're not going to do anything with that bit of information there. On 1 September 2016, machine X001 was damaged beyond repair and sold for spare parts. The proceeds of 128820 was received by electronic transfer into the bank account of Selectors in the settlement of spare parts. Now remember, in the back of your mind, what do they ask you? They ask you the IAS 16 note. What do we have to disclose in the IAS 16 note in connection with assets that we've disposed of? Only the carry value of those assets disposed of. So we are not interested whether we made a profit or a loss for the purposes of the IAS 16 note, but what we are interested in is the carry value of that machine as at 1 September. The entity had no choice than to replace machine X001. On the same date, machine X001 was sold, machine XA001 was purchased as a replacement asset on credit from a registered VAT vendor. On the said purchase date, an initial deposit of 100,000 was paid to the creditor, and after the deposit was made, Selectors still owed 951,080. So the question is, what was the total invoice price of that new asset? If we add those two amounts together, we will see that the total invoice price was 1,051,080. And obviously, if that's the invoice price, we have to take out the VAT, 1.14, and that then gives us a cost price according to the invoice of 922,000 Rand. The expected total production of machine XA001 was estimated to be 12 million units, and the machine is estimated to have a negligible residual value. Machine XA001 first had to be installed, and the installation fees amounted to 68,400 Rand VAT inclusive, and that was paid in cash. So obviously a part of our cost price will be the 68,400 Rand divided by 68,400 Rand divided by 1.14, and that equals 60,000 Rand. Good. So what is the total cost price of this asset? 922 plus 60,000 Rand. That will give us a total of 982,000 Rand. This is our estimated total production. So machine XA001 was ready to be used. Selectors closed for the holidays between 15 December and then start again on 5 January. Machine XA001 managed to produce 1.8 million units. Now that is what we're interested in. We want to see how many units that it actually produced for the financial year up to 30 June 2017. And then we also have a vehicle. So let's do the machines first. We complete our IAS 16 note, and then we'll come back to the vehicle. Just make sure that we have everything about the machines. This vehicle, this vehicle, this vehicle. Great. Good. So let's start our calculations. What do we need for our IAS 16 note? Now what I would propose that you do is to write down the skeleton of the IAS 16 note first. So let's just get rid of that one. Here's our IAS 16 note. Property, plant and equipment, the name of the entity, Selectors Limited, notes to the financial statements for the year ended 30 June 2017. This is our property, plant and equipment note. We have to show two classes of assets that do not require us to do the total column, so therefore we're only going to do the machinery and the vehicles. If you have split under the machinery X001 and X002 and XA001, 0 marks for you. You know that you have to combine all your assets, which is of the same class of asset, together when you complete your note. Good. And we know that the IAS 16 note consists out of 3 sections. The first section, carry value as at 1 July 2016. Then our movements during the financial period, which consist of additions at cost price, disposals at carry value, and depreciation. And then our carry value at the end of the year, which is, that date is wrong, 30 June 2017, which is cost and accumulated depreciation. Great. So let's start with our calculations. XAA 001. Machine XA001 was purchased for 1482. There's the cost price, 1.3 million on 15 January 2015. So what is going to be our depreciation charge up to the beginning of the year? There is no estimated residual value, so that will then be 1.3 million divided by the total capacity of 10 million, which will give us a price per unit manufactured, and then up to the beginning of the year 3.5 million units to get our total accumulated depreciation. 1.3 million. Oh, there is an estimated residual value. Sorry, there is our estimated residual value. It's 175,000 Rand, our estimated residual value. So it is 1.3 million less the estimated residual value of 175,000 divided by 10 million multiplied by 3.5 million to get to our total depreciation charge there. Our rate per unit is our cost less estimated residual value divided by 10 million units. So that gives us 11.25 cents per unit, and we have done 3.5 million, so that gives us in the 393,750. So the carry value of X01 at the beginning of the year, 906,250. If we look at X02, that was paid for 950,000 Rand. We've said that that is the cost price. The estimated residual value there is 95,000 Rand. So our depreciation, accumulated depreciation, will be 950,000 less 95,000 divided by 2 million multiplied by the number of units up to the beginning of the current financial year of 575,000. There's our rate per unit. Cost less estimated residual value divided by total capacity, 42.75 cents per unit, multiplied by the total number of units up to the beginning of the year, which will give us 245,813. So if we add the total cost prices together, the 1.3 million and the 950,000, that gives us cost price at the beginning of the year of 2250. We can immediately go to our IAS 16 note under machinery. Carry value as at the beginning, cost price 2250. And please complete this thing as you go along. Accumulated depreciation as at the beginning of the year, we've also calculated that. That would have been the 393,750 and the 245,813. That will give us 639,563. 639,563. And then our total carry value at the beginning of the year, 1,610,437, 1,610,437. Right. Good. On 1 September, machine X001 was damaged and we had to write it off. So we are interested in what is our depreciation from the 1st of July up to the 1st of September. We have our rate per unit, and there's the number of units produced up to the 1st of September. So what are we going to do? We're going to use the same rate per unit, which is 11.25 cents per unit, multiplied by the 70,000 units produced up to for the current financial period, and that then will give us a depreciation charge of 7,875 for the year under review until the date of disposal. If we subtract that from the carry value as at the beginning of the year, you will get the carry value of this asset at the date of disposal, and that is the value that we need for our IAS 16 note. So 898,375, we can insert that under our disposal at carry value, 898,375. Great. Then it was replaced with this new machine, and we have already established that the new machine had a cost price of 982,000. It had a negligible residual value, so our depreciation would be 982,000 divided by 12,000 to get a rate per unit, multiplied by 1.8 million, the number of units that it manufactured in the current financial period. So here's our total, 982,000. Our total rate would have been 982 divided by 12 million, and that multiplied by 1.8 million units gives us 147,300 depreciation for the year. Also here, we know that we have to show additions at cost price on our IAS 16 note, so we can insert the 982 as well immediately in the right slot. So there's the 982,000. So the only remaining thing is to work out the depreciation on machine X002, which we had in the beginning of the year and still have at the end of the year. So X02, we have the rate per hour per unit, and then we have the number of units, which equals 280,000 units. So there already, when we worked out the accumulated depreciation, we have established that our rate is 42.75 cents per unit. So 42.75 cents multiplied by the number of units for the current financial period of 280,000 is going to give us our depreciation on X02. That is 0.4275 multiplied by 280,000, 119,700. And that is then the depreciation on X002, and we can work out the carry value of X002 at the end of the year and the carry value of the new machine at the end of the year. Also now we have our total depreciation, all these purple ones. So total depreciation for machinery is 7875, 119,700 and 147,300. And if we add that all up, it gives us 274,875, and we can slot that in next to depreciation for the current year, 274,875. Our closing balance, we no longer have X01, but we have X02 still, which costed us 950,000, plus the cost price of XA001 was 982,000. So for the two machines at the year end, there's their cost price of 1932. The 950 and the 982. So we can slot that one in, 1932,000. Accumulated depreciation. Well, X002 would have been the 245,813 plus the current year 119,700 plus the new machine 147,300, and if I add those three together, that then will give us total accumulated depreciation of 512,813. We have written it, the 245,813 plus the 119,700 plus the 147,300 will give us 512,813. Now, I can work out our carry value, which is the difference between those two at the end of the year, 1419187. And what I can quickly do is I can work out the carry value at the beginning of the year, which is the difference between those two. And then I can just quickly check whether my thing is in balance. So I would say 1610437 plus 982 less 898375 less 274875 must equal 1419187. And it does, so this thing balances. Great, that's machines. So let's move on now to vehicles. Selectors only have one vehicle. The details are as follows. The cost price of the delivery vehicle was 275,000 exclusive of VAT. Accumulated depreciation up to 30 June 1562500. Now our estimated residual value 250,000 and our estimated economical lifetime 4 years. Now, the financial director of Selectors, together with all the accountants involved with non-current assets, came to the conclusion that this vehicle's estimated economical lifetime of 4 years was underestimated, and that a more correct estimation was deemed to be 5 years. the original estimated residual value remained unchanged. Now, if you can remember correctly, we have read here somewhere along the line that it is the policy of this entity to apply the reallocation method in order to record and disclose any change of estimates. So reallocation says we start at the current year, we let bygones be bygones, we forget what happened in the past, so we're going to apply our new estimates on our current year's figures, starting with our carry value as at the beginning of the year. So we're going to start at a carry value at the beginning of the year, and they actually gave it to you. They gave you the cost, they gave you the accumulated depreciation, so therefore I have the carry value as at the beginning of the year. 2750 less 1562500 gives me 1187500. If we did continue with the old way of providing for depreciation, and I'm not really interested in that in this instance because I'm only required to do the PPE note. So for the PPE note, I'm really only interested in the current year's depreciation charge. So for the current year's depreciation charge, we have to start then at our carry value at the beginning of the year and then apply the new estimates on that carry value. They say, well, the estimated residual value was 250,000 and that remained unchanged. So our carry value less 250,000, and they say here that the total estimated lifetime is now deemed to be 5 years. Now, don't make a mistake. What we have to work out is that 1562500 accumulated depreciation. How many years does that represent? Because remember, when we work with the reallocation method, we look forward from the beginning of the current financial year. And we can only use the remaining lifetime of the asset to determine the depreciation charge. So therefore, we will say that 156, what was the normal depreciation then? The normal depreciation would have been 2750,000 less 250,000 divided by 4. 2750 less 250,000 divided by 4, which gives us 625,000 Rand per annum. Our total accumulated depreciation is 1562500. So if we take that amount and we divide it by 625,000 Rand, there must be a divide. That will give us the number of years that depreciation, that accumulated depreciation represents, and that equals 2.5 years. So that means we've already provided depreciation for a period of 2.5 years. As at when? The beginning of the current financial year. So now they say, as at the beginning of the current financial year, we have re-estimated the total lifetime of the asset to be 5 years and not 4 years. So from the beginning of the current financial year, what is now the remaining lifetime of the asset? It will be 5 years, less the number of years that is already passed, which we have worked out as 2.5 years, and that will give us the remaining lifetime of the asset as 2.5 years. Let's write it there, remaining lifetime. Good. So, what are we going to do when we work our depreciation according to the reallocation method? We're going to take 1187500. The residual value didn't change, so we're going to subtract from the 1187500 250,000. And then we're going to divide it by the remaining lifetime of the asset, which is 2.5 years. And that then gives us depreciation for this year of 375,000 Rand. So what do we need for our IAS 16 note? We only need the depreciation charge for the year. So there we can insert under the vehicles depreciation 375. There was no new acquisitions, there was no disposals. So what was our opening balance? They gave us our opening balance. Our opening balance was cost price 2750 and accumulated depreciation of 1,562,500. 2750, 1,562,500, that gives us a carry value of 1,187,500. So we have the 375. What happened to our cost price? Our cost price, nothing happened to that. That remains 2750. What happened to our accumulated depreciation? That is the 1,562,500 plus 375,000. That's, by the way, must be in brackets. Depreciation is in brackets. So 1,562,500 plus 375,000 gives us then 1,937,500. And now we can determine the carry value, 812,500. And if we go back to this calculation, you can see there, carry value at the end of the period, 812,500. Here in the purple, I've just indicated to you the impact on current year's profits will be the difference there. It's a positive impact. And then the impact on future profits, so that will be the depreciable value in the future. That will be the difference between those two. And that means that is a positive impact of 250,000 and that is a negative impact on future profits of 250,000.